In the AAA exam, there are quite a few technical and professional skills marks available for clear, well-reasoned justifications and valid conclusions across different topics. Examiners have consistently fed back that many learners lose these easy marks as they do not link their reasoning to the scenario provided. Through this video, we'll find out that there's not much that needs to be done to be awarded these marks. We need to make sure we understand the requirement and refer to the information given so that the answer can be given in the context of this specific client. Marks for valid justifications and conclusions are commonly available in the topics shown on the screen. We are going to be looking at each of these in turn. We'll start off by looking at materiality in question number 1. You're expected to initially determine a materiality threshold for the audit, as would be the case in practice. 3 technical marks are available for this determination. You will need to have knowledge of the appropriate percentage range for the benchmark that is given by the partner in Exhibit 1. You will also have to calculate the monetary amount in respect of that range. You must then use your professional judgment to select an appropriate threshold given the risk levels in the question and provide a brief justification for your choice. Each of these steps examines a different skill that is required of auditors. I am going to be taking you through these steps one by one. You should read the information in Exhibit 1, which would specifically mention whether you would be using profit before income tax or revenue or total assets as your benchmark. So you're going to start off by calculating the lower percentage and then write the monetary amount as well. So this will be 5% of profit before income tax or 0.5% of revenue or 1% of total assets. We will then calculate the upper percentage of the range and the monetary amount. So again, if it's profit before income tax, that would be 10%, 1% for revenue, or 2% of total assets. Once we've calculated the upper and lower threshold within that range, we now need to select and justify your choice. I would recommend that you always choose the lower or mid-range because this is a risk question at the end of the day. It is highly unlikely that you can justify a higher end of the range by saying there is no significant risk. Do not simply say that there are lots of risks and therefore I'm choosing the lower range. You'll have to pick up 1 or 2 examples from the scenario to justify that you're choosing this particular threshold, and we'll learn how this is done through an example. So I've read the partner's email and the benchmark that I'm meant to use is profit before income tax. I've written down the range, which is 5 to 10%. I've done my monetary calculation, which in my case is 3.5 to 7 million, and I've easily gotten my first 2 marks within seconds. It's the third mark where you'll have to think carefully. I cannot simply write that there are lots of risks and therefore I'm choosing the lower end. I'm going to use information from the case to justify this. You would have read the scenario right at the start before you started typing up the answer. So all you have to do is pick up 1 or 2 examples from your risk question and put them in your justification. In this example, I'm going to say that although this is an existing client and I do have cumulative knowledge and experience of the company, there has been a new acquisition or there is a first-time consolidation of a new subsidiary and therefore the risk is higher and I'm choosing the lower threshold. There is an additional mark for using your chosen materiality threshold as you evaluate each risk of material misstatement that we will be looking at in a few seconds. We're now going to move on to the next topic, which is always tested in the exam, that is either audit risk or risk of material misstatement. So I might refer to risk of material misstatement as ROM as well. The examiner would either identify risks for you and ask you to justify why they are significant, or they can ask you to evaluate risks and prioritize them. We are going to be looking at both of these requirements, starting with the first one. This is an example from a requirement in question number 1. The examiner has identified 3 risks for you, and the question asks you to justify why each of these issues has been identified as a significant risk of material misstatement. Note that the requirement verb is justify rather than just list, so this needs to be supported by valid evaluation of the risk. We are just going to be focusing on the first one in my example, but in this particular attempt, they had asked for 3 different risks to be evaluated. The answering technique for such questions is the same as a normal risk of material misstatement question. We start off by commenting on materiality. You're going to use the threshold that you have chosen at the start of the question. You'll explain the relevant accounting treatment that should have been followed. The third step is the most important one. You need to identify risks through the accounting treatment that you've just outlined. Areas in the financial statements that are complex, require management judgment and estimation, or are prone to management bias are going to be inherently risky and need to be discussed here. And then you explain the financial statement impact. Remember, it could be a double entry which might be under or overstated, or it could be a disclosure which is inadequate or missing. So I've answered this question like a regular risk of material misstatement question. It is step number 3 or the evaluation in step number 3 which would be used as my justification for saying that this risk in particular is significant. We can't simply say that this is a significant area because it is material. I have to talk about why this one in particular has been prioritized. So justification factors such as estimation, complexity, and management bias need to be discussed to support this. We're going to look at one of the examples from a requirement which asked us to justify areas as significant risks. I've picked up operating licenses, which is your intangible assets. We are going to start off with our easy professional skills mark by simply saying that this is material based on the thresholds that we have decided. We then need to go on to explain the accounting treatment that has been followed. We're going to say that intangible assets with a finite life need to be amortized over their useful life, and this is being done correctly here. So this was in the information that this was being amortized. We're going to be talking about the risks or concerns that we have as auditors. We don't have the case study, but I've extracted a part of the information from the question. My concern is that the time over which the licenses are being amortized may not be appropriate. The group accounting policy is to amortize them over an average of 40 years, but the actual time period varies between 20 to 50. This means that some rights or some licenses are being amortized over too long a period. So this is material. I know what the accounting standard says. I've outlined my concerns, and I now need to wrap this up by discussing the financial statement impact. So because of this incorrect amortization, my concern or the risk is intangible assets may be overstated and amortization expenses understated. The operating licenses were for extracting fossil fuels in the question, and the scenario mentioned that globally there's a drive to reduce dependence on fossil fuels. So as people become more environmentally conscious, that demand is going to be going down. So I've picked up another risk based on this. I'm concerned that the licenses might be impaired. This would affect the ability to earn from these licenses, which translated into IS 36 language is going to affect my value in use. The scenario also mentioned that there is pressure to demonstrate that the company is sustainable or environmentally conscious, which means there's a higher risk of management bias in this area as well. So because of these combined factors, there's a further concern or further risk that intangible assets could be overstated. So I've picked up lots of information from the scenario and evaluated the risk based on a number of factors. We're going to stop here and quickly recap what we have done. I've completed my initial risk evaluation with quite a bit of support from the scenario. This link to information given in the question is very important for my technical and professional skills marks. We now have enough support to justify why there is significant risk attached to the recording of these intangible assets. So I am going to explain 3 factors in my justification, or really my conclusion for this risk. It is highly material, there is an estimation risk regarding the useful life, and there are uncertainties in terms of the long-term demand for the fossil fuels. And based on all of this, for me, this is a significant risk of material misstatement. So this was the first type of question that you would see or can see in your exam. Another requirement, which is more commonly seen, is where they ask you to refer to either all of the exhibits or specific exhibits and evaluate and prioritize the significant risks of material misstatement. It is pretty much the same question. The only difference is, and you should be able to see it from the requirement as well, that the examiner has not identified the risks for you, as was the case in the earlier requirement. They want you to read through the scenario yourself, identify risks, evaluate them, and finally prioritize them yourself. So the answering technique is going to be exactly the same. Your materiality, accounting treatment, risk, and financial statement impact. The difference is you can get up to 2 additional marks if at the end of the question you give a short conclusion to prioritize significant risks with reasons. So at the end of the ROM part of the question, or the risk of material misstatement part of the question, you need to prioritize a number of significant risks. There are a number of ways to do this, but I would recommend keeping it simple. After you've completed your risk assessment, pick up 2 risks which were higher in terms of materiality, plus they had some level of either estimation or complexity or management bias, and explain that these are significant. Don't simply say impairment and intangible assets are the most significant because they're material. You have to give a valid justification with support. This ultimately means something like what you can see on your screen right now. I've explained which 2 risks are significant and why. I've said that the acquisition and classification of the subsidiary are the most significant because of a number of reasons. It was acquired during the year, so it's new. It is susceptible to management bias, and I have concerns regarding the treatment of goodwill. Remember, all of these were basically a part of my original risk assessment as well. So I've prioritized one of them. I need to look at one more. I picked up another example from my assessment that was some restructuring project, and have justified that this is significant as there are concerns regarding the completeness and accuracy of the accounting treatment. Let's have a quick look at another example. Here, some warehouse fire is the most significant because it is highly material. It is something new that happened during the year and is prone to management bias. Secondly, the joint venture is also quantitatively material and is new or a fundamental change. You don't have to write the third one, but just to get you familiar with what else can be done, you could also say that in contrast, the delivery vans are borderline material and therefore they're not as significant as the others. So just to summarize, in a normal risk evaluation question, don't worry too much about ranking them in any order. That takes up a lot of time. I would say simply write a conclusion at the end of the audit risk question and prioritize any 2 risks with valid justification. The next topic we're going to be looking at is conclusions when you're asked to evaluate whether a new engagement should be accepted. We're going to look at factors to be considered and then see how a valid and well-supported conclusion can be reached. I've picked up a common requirement. You're asked to evaluate the matters in respect of quality management to be considered by ABC before accepting XYZ as a client of your firm. Don't be confused by the use of the term quality management. Acceptance considerations are basically an element of good quality management practices. So it's not really a quality management question. It is ultimately an acceptance consideration question. We're going to read through the scenario very carefully and evaluate the factors that can affect the acceptance decision. Consider the nature and circumstances of the engagement. See if it's a reasonable assurance engagement like audit or a limited assurance one like assurance on prospective financial information. It might also be a non-assurance engagement such as a forensic audit. You need to carry out client identification procedures, which include customer due diligence, which is a very important requirement for money laundering regulation. Based on the engagement that you're considering, there are specific preconditions that need to be looked at. In external audit, for example, this includes the management acknowledging their responsibilities regarding internal controls and financial statement preparation. Go through the scenario very carefully. Look for any concerns regarding the integrity and ethical values of the client or the management. If there's any indication that the management may be biased or they may have manipulated the information that you'll be working with, then you might not want to accept this engagement. As a firm, you should consider your resources, which include availability of competent, experienced staff and any deadline issues. So if the client wants the work to be completed within a short deadline, you'll have to consider if the firm has the ability to do this. You have to evaluate based on the information given if there's any ethical issue that needs to be managed. For example, if there's a conflict of interest with an existing client, you might need to apply safeguards to manage this. Once you've evaluated all these factors, you get technical and professional skills marks for giving a conclusion because that's what we would do in practice, right? So you've evaluated these factors and you now either need to say yes or no. The conclusion does not have to be very long or fancy, just a few short sentences. Here I can say that given the issues with management integrity, we are going to reject this work. Alternatively, in a different scenario, if the key issue related to ethical considerations can be managed, you can say that as long as these ethical issues are managed or appropriate safeguards implemented, the engagement can be accepted. So remember, there are additional marks available for giving a conclusion on acceptance decisions. The next topic we're going to be looking at is justification and conclusion in audit report questions. The examining team has specified that one question in section B will always be from the completion and reporting stage of audit. This means that your knowledge of audit opinion and reporting is going to be tested in every single exam attempt. The key point to remember is that you need to justify the opinion you are giving instead of just naming it by saying a qualified or an adverse opinion would be given. A common requirement may be worded like this. You would have explained further audit work to be done in Part A. In Part B, the examiner wants you to assume that the management has not made any further adjustments to the financial statements and justify an appropriate audit opinion explaining the aggregate impact of both misstatements on the audit report. So there were two misstatements that you would have discussed in Part A. Let's look at the step-by-step answering technique that can be used across all opinion and reporting questions. Starting off with step number 1, identify whether the issue is a misstatement or an inability to obtain sufficient appropriate evidence. Remember, a misstatement would mean there's a problem in a double entry or a disclosure, and I've identified that problem. And inability would mean auditors have not been able to gather enough evidence to conclude whether there's a problem or not. You then have to decide whether the aggregate impact is immaterial, material, or pervasive. We know the ranges for quantitative materiality. Please don't forget that there are certain areas in the financial statements which may also be material by nature, such as related party transactions. Additionally, we need to consider whether an area or areas could be material and pervasive. Pervasive could mean there are issues in many parts of the financial statements, or there's a problem in one particular double entry that changes the outlook of the financial statements. An issue with the disclosure can also be pervasive if that disclosure is fundamental to users' understanding of the financial statements, such as the going concern disclosure. So I need to do my assessment and decide whether this is immaterial, material, or material and pervasive. Remember, our requirement asks for the aggregate impact, so we are going to be looking at the combined impact of both the misstatements given in the question. Based on the first two steps, you're now ready to name the opinion. Assuming the aggregate impact was just material, you're going to say that the opinion would be qualified except for due to material misstatement. You have to justify why you've given this opinion. Your judgment said this was material only, so you're going to explain why. We're going to say that this is material but not pervasive, as these do not represent a substantial portion of the financial statements. Finally, you need to explain the impact on the audit report. When the opinion is qualified, you have to go on to explain how this affects the headings and the content of the opinion and basis for opinion paragraphs. So what you see on the screen right now is the complete answering technique with the justification marks for an audit opinion and reporting question. Let's have a look at a short example. I'd recommend that you pause the video and read through this carefully. We started off by explaining that these are material misstatements. I haven't written the background, but this question related to an incorrect retrospective accounting treatment for accumulated depreciation, and there was a lack of disclosure of related party transactions under IAS 24. The aggregate impact is still just material. I then go on to explain that this is material but not pervasive, and therefore I'm going to give a qualified opinion due to material misstatements. I need to explain why it's not pervasive. So I'm going to write that this is not pervasive because they do not form a substantial portion of the financial statements, nor do they relate to a disclosure that is fundamental to users' understanding of the financial statements. Yes, it is an inadequate disclosure, but it is not that important or fundamental that I would say that the entire outlook of the financial statements has changed because of this. And my justification is done. I'm going to wrap this answer up by discussing the impact on the audit report. I'll explain how the headings of opinion and basis for opinion paragraphs will change, and also write that the basis for qualified opinion paragraph, which is placed underneath the opinion paragraph, will describe and quantify the misstatements and the details of the disclosure. So just a quick recap: discuss the problem misstatement inability, identify the opinion, justify it by explaining why or why not it is material and pervasive, and ultimately explaining the impact on the audit report. The next topic that we're looking at is a conclusion on ethical considerations. When asked to evaluate ethical issues in a AAA question, reaching a well-reasoned conclusion is the primary outcome of your response. This is where you apply your knowledge of the code of ethics to the scenario presented. This is very similar to what you would do in practice when you come across an ethical issue. You would consider what the code says about this, you apply it to the situation, and then you decide what needs to be done next. This is an example from a past exam question. The requirement asks you to use Exhibit 5 and discuss the ethical issues raised, plus recommend actions to be taken by the firm. The information in Exhibit 5 is on the screen. The group is not listed, but they follow best practice corporate governance principles. They have an effective internal audit department which reports to the audit committee, which is made up of independent non-executive directors. Now, the group finance director does not have the expertise to convert the following accounting standards to IFRS. Your firm has been approached for assistance in this matter. They've asked that as a part of the audit, your firm should make the necessary adjustments to apply IFRS accounting standards to the newly acquired subsidiary and then consolidate that information into the group financial statements. The answering technique for questions on ethical issues is quite straightforward. You identify and explain the threat. Don't just name it like saying self-review or self-interest. You'll have to explain how or why it is a threat. Explain the relevant guidance by the code. You would need to know what the code says about this, so please make sure you are aware of that knowledge aspect. And finally, you evaluate how significant this threat is and conclude on what needs to be done next. Your evaluation and conclusion could be that this can be managed with appropriate safeguards, or it could be that the threat is so significant that no safeguard is possible and we cannot accept this additional work. Let's apply the answering technique to the question that we just saw earlier, which is where the external auditor is being asked to convert the local financial statements into IFRS and consolidate them. I'm going to start off by explaining self-review threat. Do not simply name it. Explain that because of the over-reliance on the work of their colleagues, the auditor's objectivity might be compromised and they might not audit the adjustments properly. The code says that even for companies that are not public interest entities or are not listed, these services cannot be provided unless they are routine and mechanical. Now, routine and mechanical here means that these should not require any professional judgment. I'm going to go on to evaluate and see whether this is routine and mechanical. The conversion of local accounting standards into IFRS is going to be complex and it will require judgment. Therefore, we can easily say this is not going to be routine and mechanical work. And based on this evaluation, my conclusion is that we are going to reject this engagement. By giving a valid conclusion based on the ethical guidance, you are getting your easy technical as well as professional skills marks in the exam. The last topic that we're going to be looking at is reaching a conclusion on quality management questions, one of my favorite topics really. When you see a question that refers to quality management, be prepared to be tested on a number of topics from across the syllabus. These questions test your knowledge of auditing as well as quality management standards. As you read through the scenario in the exam, be alert to indicators that the quality of work might have been compromised, which in some cases may be due to financial pressures on audit partners. You should be looking for issues related to poor planning, inadequate risk assessment, lack of resources, proper evidence not being obtained, etc. The most important point to remember is that you have to reach a conclusion regarding the overall quality of audit. You should also read the requirement carefully to see if you're being asked to recommend further actions that should be taken by the engagement team. If yes, as a part of our conclusion, we need to make sure we talk about these further actions as well. Let's read through a common exam requirement. You're required to evaluate quality management, ethical, and other professional matters arising in respect of a particular audit. And in this question, you also have to recommend appropriate actions to be taken. You should read through the scenario very carefully and look for indicators that the professional and ethical standards might not have been followed. We're going to look at a few examples of commonly tested quality management deficiencies. Look for any ethical threats that were not properly managed. Remember, in quality management, one of the elements is following the code of ethics. So, for example, if the engagement partner has been auditing a listed client for more than 8 years and has not been rotated or sent off for the cooling off period, you're going to identify this as a quality deficiency and explain how familiarity and self-interest threats may have affected the auditor's objectivity. It could be that materiality was not reviewed during the course of the audit. Remember, preliminary materiality is set at the planning stage, but it needs to be reviewed throughout the audit. If risks go up or if new risks are identified, materiality has to be decreased. So in the question, explain how this lack of revision might have affected detection risk. Another one quite frequently tested is that there was insufficient audit evidence obtained about a particular area. For example, the audit team may have relied on poor quality internally generated evidence such as board minutes where better quality third-party evidence was available. So ultimately, they were not able to or they have not obtained sufficient appropriate evidence about a particular area. You should look for any indication that the engagement partner or the manager was absent throughout the audit, which would mean there was no proper supervision or review of the audit work. Be alert to inappropriate delegation of tasks. For example, if juniors were working on financial instruments or going concern, this indicates poor quality as they won't have the knowledge or experience to do this work effectively. Be alert to indications that audit was done quickly. It could be because it wasn't planned properly in terms of the timelines, or maybe because the team was being intimidated by the management. Look for any indicators that complex or judgmental areas of the financial statements were not identified as risky areas and detailed audit work was not done on them. Be alert to any indication that the audit team does not have appropriate skills or experience for this particular client or industry, or maybe they were inadequately staffed in terms of number of people working on a particular client. There could be concerns regarding the audit plan and strategy. This has been tested in both directions. Maybe new risks were identified after the planning stage, but the audit plan wasn't changed to reflect this. Alternatively, it could be that the audit strategy and plan were changed without a proper justification or documentation. For example, the sample size was reduced without any reason or without any discussion with the audit partner. You should be alert to indicators that the quality of audit work is being compromised due to cost constraints. This could mean that work on material areas was skipped or an expert or consultant was not appointed even when there was a need for one. Now, let's stop here and see where we're at. I've used the scenario and identified the quality deficiencies and explained them. So for each of them, I've picked up words from the scenario and explained the exact problem that deficiency would cause. The question also asks for actions to be taken by the firm. An important point to understand is that the next steps depend on whether the audit report has been signed or not. If this is a pre-issuance quality review and the report has not yet been signed, one of the actions that could be taken is that I would need to carry out additional review or additional work. I might need to discuss this with the client and ask for extension of the deadline for the work to be completed without compromising on quality. Examples of other actions include sending the audit staff for training. If there's been a serious breach on the audit engagement partner's part, we would be talking about a disciplinary action against the partner as well. We can also consider reporting ethical issues to the firm's ethics partner. And finally, step back and see if the identified quality issues indicate that there are wider quality issues at the firm level which need to be addressed. So you'd be getting some very easy marks if you talk in this direction as well. I now need to come to an overall conclusion for easy technical and professional skills marks. Based on my evaluation, I'm going to summarize that I am concerned because of the cost constraints, important elements of the audit plan were not followed, or the audit was not properly directed, supervised, or reviewed, and therefore I need to carry out further audit work because the report has not yet been signed. On the other hand, if the report had been signed, my conclusion would be slightly different. This would need to be reported to the firm's ethics partner, or a disciplinary action may need to be initiated against the engagement partner. The main point to remember is don't just abruptly finish off quality management evaluation, reach an appropriate conclusion because that gets you easy marks in the exam. And finally, as with all AAA questions, it is important to ensure that you practice applying these techniques by working through as many past exam questions as possible.